90%. That's roughly how many professional fund managers fail to beat a simple index fund over the long run. These are people with finance degrees, research teams, and computer models, and 9 out of 10 of them lose to a strategy you can set up in 10 minutes. Today, we're decoding the real math of index funds versus picking stocks, and why the boring option keeps winning. First, what an index fund actually is. Instead of betting on one company, you buy a tiny slice of hundreds of them at once. An S&P 500 fund holds all 500 of America's biggest companies in one purchase. You're not betting on any single business. You're betting that the American economy, as a whole, keeps grinding forward, which, over any long stretch in history, it has. Now the number that changes everything. Over the last century, the broad U.S. market has averaged roughly 10% per year before inflation. Not every year. Some years it drops 30%, but the long arc bends upward, and 10% a year, left alone, does something the human brain genuinely struggles to picture. Here's what it looks like. $500 a month invested in an index fund at historical average returns. After 10 years, around $100,000. After 20 years, roughly $380,000. After 30 years, over $1 million. That's not a lottery outcome. That's the median path of just staying in a market and not touching it. So why doesn't stock picking work for most people? It's not because picking winners is impossible. It's because of a brutal statistical fact. Most of the market's gains come from a tiny handful of stocks. Study after study shows a small percentage of companies generate nearly all of the market's wealth. Miss those few, and you underperform badly. An index fund cannot miss them. It owns everything by default. Then add the professional evidence. The SPIVA scorecard has tracked this for over 20 years. Across long periods, roughly 90% of actively managed funds fail to beat their benchmark index. If the professionals, with every advantage, can't reliably do it, the odds for a part-time stock picker with a day job are worse. Much worse. And then there's the quiet killer: fees. An active fund might charge 1% per year. An index fund charges as little as 0.03%. 1% doesn't sound like much until you compound it. Over a full career, a 1% annual fee can quietly consume a quarter or more of your final wealth. Same market, same returns. A fortune transferred to the manager for losing to the index. But here's the part most index fund videos won't tell you. There is a case for individual stocks. If you buy a great company and hold it for decades, the tax treatment is beautiful. No capital gains until you sell, full control of timing. And if you genuinely know an industry deeply, professionally, you may see things the market is slow to price. Concentration is how large fortunes are built. But understand, it's also how they're destroyed. Diversification is how fortunes are kept. The honest framework looks like this. The core of your wealth, 80 to 90%, goes into boring, diversified, low-cost index funds. Gutematic, monthly, no decisions. The remaining 10 or 20%. If you love markets, that's your stock picking allocation. Your edge, your research, your swings. If your picks beat the index, wonderful. If they don't, and statistically they won't, your future was never at risk. One warning about behavior, because this is where the real returns are lost. The index fund's biggest enemy isn't a bad year. It's your finger on the sell button during one. Investors reliably earn less than the funds they invest in because they buy after rallies and sell during panics. The math only works if you stay in. Automate the buying. Ignore the crashes. The market's job is to shake you out. Your job is to refuse. So, 90% of professionals lose to the index. A handful of stocks drive nearly all returns. Fees compound against you. And the biggest risk in the entire system is your own behavior. The boring strategy isn't a compromise. It's the math. If this changed how you see investing, subscribe. Every video, we decode how money actually works. Because the people who understand the system are the ones it works for.